Hello and welcome to Money Control, where we continue with our series on how to ride this bull market. I'm Mahalakshmi and I have a guest who will help us navigate the technical side of the market. How do we juxtapose, when you juxtapose the fundamentals against the technicals, how do the markets really look poised? Thank you so much, Rohit, for joining me this morning.
Thank you, Mahalakshmi, for having me. Very interesting point when we are getting so close to the 20,000 mark. A lot of
Absolutely.
people.
Yeah, yesterday it
Everybody,
looked like, we were at a kissing distance from the 20,000 mark. But today we've backed off a bit, weighed down by, unpleasant surprises from some of the index heavyweights, HUL, Infosys particularly, and the entire tech sector. So what is your sense? Is this, would you read too much into it, or the momentum of the past week should continue going into next week?
So looking at the structure of the market overall, the way it has developed from the lows of March so far, it doesn't look like this particular rally is complete. And when I say structure, of course, we are referring to the Elliott wave patterns that allow us to sort of map how something is unfolding. Will it extend? Will it pause here for a while? And we are not getting clues of another pause yet. It could happen at some point of time. And if there is any pullback, it ends up being 1 to 3 days, usually not falling below the daily moving averages. And so that is about all. Like even right now, our expectation from yesterday is that you had a 5-6 day run. At the most, you can pull back and retest the last 2-3 days lows, and then probably continue higher all over again. I think that's sort of what is happening right now. And particularly to some of the large caps that are driving it. If we talk about, say, the tech sector in particular, and I was actually discussing it with you a while back. It gives me a deja vu moment to think about 2002 April when Infosys downgraded its own earnings and hit lower circuits, and that ended up being the low point for the stock for the next decade or two. So we are asking ourselves, is this a similar moment? Because bad news never comes at the top. It's always comes at the end of a down phase, and we've actually had a long down phase for the Indian IT sector, even as US tech stocks have recovered. So that's one part of the market. Give it a day or two. I think the panic from the IT sector will settle itself. Then we start looking at what the others are really doing. I think one of the others I can see as a loser right now is Reliance Industries, which is also a large cap, just gotten demerged, and it may be a 1 day reaction to people making some booking some gains after they got hold of the subdivided shares. But if we look at what has really happened to Reliance, and since I'm talking about stocks, I'll just mention that we don't really give advice. So these are our observations on the chart. What has happened is that Reliance Industries has broken out from a downward slanting channel, which was in place for the last 1.5 year, when it was underperforming to the Nifty. And it has actually, that breakout usually means that this is not something that just ends in a few days. It's something that can last for weeks or months. And so it's a very important breakout that has happened. And therefore, whatever profit booking we are seeing might just be, again, temporary. So drawing from the large caps that are pulling the Nifty down today, I sense we watch for a day or two. The Nifty itself should find support somewhere between 19,800, 700, 650 maybe worst case, and then start higher again.
Sure. It's interesting you talk about, stocks bottoming out. So are you saying that the bottom for Infosys and Reliance, of course, will mark the bottom for the market, and you're suggesting that they are looking like they are at the bottom?
Well, what I'm trying to say is that they may not be the reasons for a major panic, because when news like this comes in, you start wondering, oh, was this like, the pin that breaks the bubble type of theory? And when you look at the individual cases, the tech sector has been through its worst and trying to emerge from that. So, which means it is clearly not at an all-time high. And Reliance Industries, which was underperforming, is now contributing the most to the index. And so, in that sense, there's actually been a change in pattern as far as these stocks are concerned. So definitely, those are not reasons why we should think that the markets are overdone. You need to slightly take a step back and look at the picture across the board, and then take a view on what is really going on.
Sure. So just one question on tech. why do you say that the worst? I mean, tech has seen its worst, because business-wise, if you really see, it's only in the last quarter that we started to get some bad news at all. And every time the business gets bad, at least a 4 quarter to 5 quarter, you will see sluggishness on the business front. So why do you think this is not too early to call a bottom?
So there's always a lead lag between fundamentals and technicals. The reason for that, I mean, maybe understood in many different ways. It has to do with sentiment, behavior. So we've surely seen underperformance by the IT sector. But if I just look at the IT index chart, which I've just opened in front of me, I see that it made a low, say, in July of last year at 26,189. That low has still not been broken on a closing basis. So we touched 26,188 again in September, and then we touched 26,184 in April of this year. So which means 3 times we've touched the same level, not broken it on a 12-month basis, which we would still think has been one of the worst phases for the sector. So its underperformance hasn't really meant that prices start crashing to new lows. So in fact, technicians would call this a triple bottom. Now, the alternate thing to think about is one, how is technology doing around the world? So the tech sector is actually still the most favored sector, because you're seeing performance in US tech stocks driving interest in the sector. But it's because of new technologies, AI, and those developments that are going on. And then you think about Indian IT, will they do as well as the tech sector is doing around the world? And you'll have to segregate maybe companies that are working in that space, working on new products, and where their business is not simply tuned around labor arbitrage. I think that's possibly the way to think about it, which is why a lot of mid-cap IT stocks in specific areas of business have done much better than the large caps on a 10-year basis.
Right.
Of course, post-COVID, you had this special period where everything did well. And now, will that continue or not is the question mark. But so there's price performance and there's relative performance. On a relative basis, we can come up with a theory and say that, well, IT may not do as well as cyclicals because the core economy is growing and you have a capex cycle and so on. So should I invest in those stocks relative to IT? Maybe. But that doesn't mean that IT stocks fall to new lows. They may start performing with the market, just relatively not so well, except on a stock specific basis.
Sure. So, but Rohit, first, give us a sense of the overall, environment of the market in terms of, whether you look at advanced decline ratios over the last 1 year, whether you look at, any other parameters, the moving average parameters. How does it really stack up? Does this show characteristics of a strong bull run?
So what we are seeing, and this is true not just in the US, but in India, in both places, and I can explain it, is that slowly and increasingly participation coming in from different parts of the market and different sectors of the market. One of the ideal definitions of a bull market is that everything participates. And we can see that because for almost 18 months till March, you didn't have participation from mid and small caps in a big way. You still had some stocks doing well, so you didn't have an outright across the board crash as well. And now, as we started to recover from those lows, you're actually seeing a lot of stocks and sectors play out on the upside, whether it's reality, even IT recently, as we'll see, it has sort of participated, if not in a big way. The metal sector is seeing some sparks, which I think should improve as the dollar view gets more strengthened in the coming weeks, which is the macro backdrop to think about. But basically participation, if I just since you mentioned things like, how stocks are participating, one way to measure it is number of stocks above the 200-day moving average. Now, as a percentage in the Nifty 500 basket, that number is at around 79%. At the lows of March, it was at around 29 to 30%. And it has incrementally been increasing. So it has not really fallen. Even if we take it from July, it was at around 72. So it has moved up a bit. So we are slowly seeing more and more stocks fit that number. And if you want to see, what was the peak number in terms of when we were at the top of October 2021, it had reached almost 98%. So we are not at that level. We are seeing increasing participation, and which is why I think this is still a market that is, getting breadth. Now, If people are watching the US, this is also a complaint people make there, saying only it's just the AI stocks doing well, or only those handful of tech stocks driving it up. And what we've seen in the last month is participation kick in from one, the banking sector, which is now even been in the limelight because of the recent results, beating expectations. So the negativity which was around US banking till March, April is sort of, petered out, and bank stocks are starting to participate. You're seeing that also in the Russell 2000, which is more of a small cap index, but has a larger basket of stocks, which was doing something very similar to our IT index, making multiple lows at the same level, a triple bottom, you can say, and it has started to break out of that zone. So increasing participation, I think, is a good sign for these markets to continue ahead.
So, so Rohit, you said 79% of stocks are trading above their 200-day moving average, right? And you said the
That's
corresponding
right.
number for last year was 98%. Now, when you look at the market cycles of the past, where would this 78% really fit in? Would you call it mid-cycle, early cycle? What stage would you say are we in?
So it could be a little early. Say when was the last time we were at 78%? The post-COVID rally from 7,800 all the way to 10,300. When we reached 10,300, we were at a similar level of 79%. Okay, so that sort of gives you perspective. That's sort of halfway, not even halfway. In fact, it's before halfway of that rally we were there. So it takes time for the markets to mature, and usually what happens is that it's not just you reach 98% and the market peaks out. There are divergences. So when the market continues to rise, and then you find that the number of stocks which are above this kind of a long-term average are starting to reduce, that's a sort of sign that it is petering out. So the high number right now is just a sign that you're getting more participation. So like you said, it's not even halfway there if I compare it to 2020.
Sure, sure. And what are you picking up from the, what kind of global cues are you getting when you look at, let's say, the US 2-year yield or the 10-year yield? What are you picking up from those charts?
Yeah. So that's I think the most important part of the macro discussion, when we are really taking a big picture view and trying to change our stance from one side to the other. And what has happened over the last 6 months, both on the dollar and bond yields, is, I think, the key to getting a hang on why markets are doing what they are, and they're moving way ahead of the curve. So that we can't deny. They're probably discounting things 3 months, 6 months in advance. That's what we are realizing now. But if you go back and look, the dollar peaked in September of 2022, and
Right.
that is when the intervention by Britain took place because of its insurance market problems on rising bond yields. And once they intervened, you find that the British pound started to strengthen against the dollar pretty significantly. So that became the first currency to meaningfully, strengthen against the dollar. That, I think, marks the end of a almost 12-year bull market. I think it started in 2008. So it's not even 12, it's 14-year bull market in the dollar from the bottom of 2008 to the top of 2022. And ending such a long bull market in the dollar is key to understanding where money moves next, because the last boom phase in emerging markets between 2001 to 2008, which was a 7-year bull market, was associated with a falling dollar when emerging market bonds ended up doing extremely well. And I think that environment is getting slowly built in. So what we say, and it's the first quote of my most recent long short report, is it's a Mark Twain quote, which is history never repeats, but it
But
often
it
rhymes.
rhymes.
And
Right.
when we say that, what we are really trying to say, we'll find a lot of similarities with the past, but it will not be verbatim. It will not be word to word, step by step, exactly in that order. But the same themes exist. And the similar themes back then were a falling dollar and a strong emerging market environment. The falling dollar has taken its while because we've had a recovery post COVID, but the dollar managed one more run in 2022. I think that marks the end of a dollar bull run that has lasted for so long. And now you have an environment where the dollar is likely to be weak and other currencies are likely to be stronger. This has started to now show up even in the USD JPY, the Japanese yen, which had been weakening for a long time. Recently peaked at 145 and started to fall because even the Bank of Japan sort of backed off from the idea that they need to keep stimulating by buying bonds, and they There's still talks. They haven't done anything in terms of the yield curve, but there is hearsay on that changing. So essentially, I think step by step, every currency starts to strengthen, I think, against the dollar, and it has a more direct impact on emerging market currencies. So that is where, if you look at the USD INR, which is what concerns India, it has been stuck in this range between 83 and say 81.50 for almost a year now.
Right.
And it's formed what we technically call a triangle. Now, triangles can be argued in both ways. We can say that, the triangle is a consolidation and it will head higher. But at the same time, when the triangle occurs after many, many years of advance, it can be something known as an ending diagonal, which is also a topping pattern, which is what I suspect is the situation here. The confirmation will be when you break below, say, 81.70, 81.60, that will sort of confirm that the Indian rupee is starting to strengthen against the dollar. We already have the backdrop of, a change in FII flows, but you want to actually see the rupee itself show that, which would be a confirmation. So I think the USDNR breaking 81.70 to me is one of the last things left to confirm, because the dollar index is already broken its lows for last year, confirmed that it is, weakening. US bond yields have made sort of a double top right now. And I think with inflation rates in the US falling, they will head lower from here in the coming months, slowly and steadily, not eventually. In fact, Fed's meet is next week. I would sense that would be a trigger for bond yields to start falling again from the levels they are at currently as far as US is concerned. But here's the good news, because like I said, USD INR is the only one not yet confirmed. The Indian GSEC, the Indian bond yields, they broke below a similar triangle pattern that had occurred most of last year. Since April, they have broken that level, which was at around 7.25%. And having broken that level, they are now in a downward trend, which means bond yields in India are indicating lower interest rates eventually for the Indian market. And I think that's a very positive sign, positive trigger eventually. RBI may not have moved yet, but the bond market is indicating that that's where we are eventually heading. So if I take a 6 to 12 month view, I would expect interest rates to be lower than where they are here. As far as India is concerned, I would expect the rupee to be stronger than where it is, all of which is essentially what we see during expansionary bull markets in an economy, or rather when you have a cyclical boom, where you have core sectors of the economy, things like manufacturing, capital goods, all these start doing well, which was 2003 to 2008. And that's very, very similar to what we are seeing right now.
Sure. So on the dollar index, Rohit, do you see any risks in the short term? Because it's been flirting under 100 for a few sessions and then not gone any further. It's sort of rebounded from there. Do you see any short term implication at all? And the other question is, this week, the coming week, that is on Tuesday, Wednesday, you have the FOMC coming up. And typically, if you've seen the trend over the past 1 year, the Fed has been constantly talking down markets. And, market invariably, if it goes up prior, it tends to correct over the next few sessions. So what do you look at, in the short term, how do you view the dollar index as well as the markets?
So it is true that the dollar index took a pretty sharp cut last week as data came out around inflation, especially the CPI and core inflation data that came out early mid of last week, I think. That caused the dollar index to break all the lows of last year. Now, because it's fallen so sharply, we can think that, okay, maybe it bounces back. In fact, it bounced yesterday also and stays elevated a little bit in the short term till the Fed really speaks on it again. That's, I think, the gap. The larger picture is, of course, clear that I think the dollar heads lower. My sense on what the Fed is really doing is, I think they're doing what a lot of central banks do, which is they use language as a monetary policy tool. Interest rates where they are, even though they are saying that they may have 2 more hikes on the table, what they mean by saying that is that we are prepared to do that if the situation warrants. The data itself, if I go by simply inflation data, doesn't warrant further rate hikes. It simply means that, okay, it's working in our favor. Let's just sit back, let rates be where they are, let it get contained. Unless there's an unexpected jump in inflation data, I don't think they will be in a mood to raise rates. They may just continue to talk about it. And so I think the market will like that in a way that, if they don't hike and continue to watch data, and the data is still easing, then that ends up being positive for the markets. But between now and then, surely we can see a languishing pattern. But in our own market, I don't see weakness, and the reason is that there's a lot of rotation. Uh, just take today, for example. Right now, you'll find that there is strength in auto stocks. Now, auto stocks were actually down for the last 4 to 5 days. If we go back 5 days, the same was the pattern in banking, which was down when the Nifty was down for a day, banking was down for 3 to 4 days, then banking picked up. So this rotation from one sector to the next is ensuring that Nifty by itself doesn't end up having a correction which lasts very, very long. Whenever and sectors do their own thing, they're correcting, and even within the sector, different stocks correct a little more or a little less. So it's become very hard to really call a top and say, okay, now this is too much and it's going to, not going to rise anymore from here. And like I mentioned at the beginning, the wave structure, which is our primary model to sense whether that is happening, is also not indicating that as yet. There was a chance when we were at, say, 18,900 that, okay, it pauses here for a while. But once it got past that, we are in what we call an extended move. And in an extended move, you just want to trail the market with levels rather than try to say it's going to top here, because then you miss out on something if it exponentially moves in the upward direction. So the right approach is to use trailing levels. You can use a simple thing like a 20-day moving average, or you can use classic Dow theory of higher highs and higher lows. And you find that the market is simply not making lower lows. It's not breaking previous swing lows. Each time it goes up, it makes a higher low. And as long as it is doing that, you want to just stay with the trend. That's going to be the approach.
Sure. Sorry, one more question on macros before we get into trading strategies. What's your view on crude? Because crude again, has been inching up a bit, $67 or so now. It's gone up to $76 or so. So where do you see that settling? Are there any near-term risks coming from there?
So crude has been slightly tricky. I do feel that with my dollar view, the entire commodities basket is in the process of bottoming out. But oil sometimes does some kind of a lead lag. So even if we say 2020 copper prices bottomed first, and then there was some news around excessive oil inventory that drove one final flash crash in oil. So the risk is that at some point, if oil doesn't get past, say, $80 to $83, it can maybe retest $68, $65. That is like a risk in my view, but not a certainty. But once we do get past 80 to 83, or if we get that last dip, from there on, oil prices would also join the commodity cycle on the way up. So apart from this near-term risk to oil having one more knee-jerk reaction to the downside, if I take a 3 or 6 month view, I would say oil prices would be higher than where they are here. Maybe eventually head towards $100 again. But the key will be how fast that happens. As long as the advance in oil prices is slow, it will not be seen as a major risk to markets. It's only if the advance is very, very fast that it would create risk to markets. So that's how we should look at oil. But definitely we are getting to the point where the downside to oil comes to an end with the commodity cycle.
Sure. Now, let's just look at it sector by sector. The biggest heavyweight in the index, banks, how do they look to you now?
So I think banks have been strong, but they've also been good in giving pullbacks. I was mentioning earlier the Nifty doesn't do that. But even Bank Nifty, when we were at 18,900, had a 3-week pullback in terms of being down for 3 consecutive weeks on the weekly charts. So it's really done well in terms of pulling back, consolidating, and then heading higher. I think there is no sign yet that this particular move for banking has ended. So we would continue to remain bullish. We'll continue to trail, like I said, with higher highs and lows. Maybe around 45,500 is a good near-term support. Overall, we would look at heading towards maybe 47,000 shorter term, 50,000 maybe eventually.
Sure. Rohit, usually, the way to trade in bull markets, they say, is, bet on the stronger candidates, winners of a bull rally. This time, if you see the EMS stocks, the capital goods stocks, the defense stocks, these are the ones that have really run up in this time around. do you look at, a bubble kind of situation? Because fundamentally, a lot of analysts are arguing that these stocks are really overpriced and may end up disappointing. But when you look at it technically, do you get a different story?
Yeah, so technically there is no sign of a trend reversal, and here's the interesting thing about the valuation argument. If we go back to the 1990s tech bubble, right, the Y2K move. Y2K is of course just a date, but the tech bull market was lasting for several years, and once it got into the late stages of that move, I think post 1997, 1998, tech stocks were always considered overvalued because PE ratios were always above 50, above 70, then above 100. We even see 150 times for Infosys at one point of time. And even that would look overvalued. But this is the beauty of markets, is that sometimes, even if you think it's a bubble, it goes on for longer than you think. I don't know for sure whether we've entered bubble territory yet for these sectors, but their charts are not yet indicating something that is coming to an end. So I would still look at points where there are pullbacks or consolidations in this sector as entry points to an ongoing move, because as you mentioned, you have to chase where the performance is in terms of your allocation. Of course, at a later and later stage, you will feel scared to do that, and you look for the next stock and the next stock, and that's partly what drives participation. That different sectors that are not participating start playing out because money starts looking for different homes and not chasing up the same stocks. But trend reversals between sectors don't really happen. I mean, if this is an ongoing bull market, it won't happen that suddenly you have defense stocks going on a downward trajectory and you have other sectors on an upward trajectory. So it doesn't work that way, which is why it won't be right to assess that you are in a bull market and these sectors are going to do badly. So
Sure.
my sense in that is that they'll continue to do well.
Sure. So if you just were to, map the entire mid-cap space, because that's where a lot of action seems to be happening, can you call out bubble zones, if at all you see anywhere, and strong pockets that'll do well over a 3-6 month time horizon?
So in mid caps, one has to be very stock specific. And even within sectors, like say now there's a pharma, you would want to pick individual names that are going through their own manufacturing boom, maybe finding segments to export to. So then you look for that. You wouldn't want to be in the large players. It's the same thing as we said in IT, that you want to be in mid cap IT versus large cap IT, and mid cap IT has done better. If I run a scan, sometime back I was running a scan for stocks that are trading above the 50-day moving average for the last 100 days. And the top stock in that, one of the top stocks from the IT sector was Sonata Software. Now, that's a complete outperformer within compared to the large caps, right, which have been languishing.
Right.
So that's the kind of thing you'll really need to do in terms of finding individual stocks which are doing well in particular segments. And I mean another scan. Now I'm mentioning scans because we don't want to say that you buy this, but scans are a first step towards finding ideas. So another one which showed up, and we have been liking sugar sector for a long time, but when you look at a big sugar player like Balrampur Chini, it has not done so well. But there's another one like a smaller stock called Ugar Sugar, which has been consistently performing. So then that calls you to really go and look into what is going on in that particular stock, a particular segment, why it is outperforming, and does it make sense in terms of participating there in the ongoing move. So you need to take that kind of an approach in mid caps. But surely, again, in mid caps, like you mentioned, are we in a bubble? If I do something which is known as the Nifty to mid cap ratio, and the Nifty to mid cap ratio was stuck for almost a year in a range because it was sort of not underperforming but not outperforming. It was like a flat range for that entire period in 21-22. Now it has broken out of that range on the upside, which means now mid caps are again outperforming the large caps. So clearly you want to be in that space. Now, if I take a 6-year or 10-year chart, is this ratio at a new all-time high? The answer is no. In fact, we are not even back to the highs of 2020 before COVID. And that sort of gives you a sense of, are mid caps relatively more expensive than large caps than they were in 2019-20? The answer is no. And so we are not there yet.
Sure. So would you dare to call out the weakest spots?
So I mean, see, even I mentioned pharma. Say, for example, within pharma, there are some stocks that would have fallen 70-80%. Okay. So you have even big names like a Lupin have lost a lot of ground during 2021-22, post the initial inertia that you got from COVID buying into pharma stocks. So now pharma as a sector, therefore, has actually not done so well. It's a place that I wouldn't be too interested, except in specific names, as I mentioned earlier. If you find pockets of where something is happening, yes. But overall, they may not do as well as the growth sectors, which are doing strong. So that doesn't mean pharma stocks fall, but they underperform. So in that sense, that wouldn't be I wouldn't want a major allocation there, except in specific stocks. I do feel similarly about FMCG. That they go through these cycles of 10 years of super performance and then 10 years of underperformance. And we saw that through the 90s outperformance, then 2000s underperformance, 2010s outperformance. And I think another cycle of underperformance comes in for FMCG. So these are sectors where, in general, I would want to be underweight.
Sure.
Now, within mid-cap, you look at stocks which have collapsed. If they've given up 60-70% of the gains they made post-COVID, those are where I would be concerned, unless you're really convinced about the story. So I would do the same performance run that, other stocks holding above like the 50-week average, for example. And those would be a preferred list than those which have broken and gone far below it.
Sure.
So clearly just clean it out and, chase performance. The same argument that you made earlier, I would completely use in the case of mid caps as well.
Sure. How about small caps? I mean, I know that you can't look at this as a lot, but there is a lot of action there also. And usually the froth builds up in small caps a lot more, isn't it?
But it goes hand in hand, with what mid caps are doing. And if mid caps are doing well, small caps are doing well. It's just the choice and liquidity factor that can help you make or not make that decision. Because if you're a small investor, you're buying 100, 200 shares, you don't care about a stock that trades only 5,000 shares a day or 10,000 shares a day. But if you're doing something sizable, if you have a large portfolio, then taking a stake in a small stock requires a lot more insight, because you are not going to have the liquidity to exit tomorrow morning if something goes wrong. So then the research that really goes into small caps is a lot more for a big player than a small player who has the liquidity to exit.
Sure. Rohit, also going with, your logic that, a sector like FMCG goes through long periods of, outperformance and underperformance. Now, auto is coming out of a long period of underperformance for the last few years. How do you see that space? Because there is, again, a lot of momentum building up, not only in the auto companies, but also in ancillaries.
So I wouldn't think autos actually went through too much underperformance, except maybe two-wheelers, like say Hero MotoCorp did particularly badly. But if you take the auto index or stocks like M&M, Maruti, they actually outperformed. In fact, in October, first half of 2022, when the Nifty fell from 18,300 all the way down to 15,200, the auto index was actually going up completely against the market. And so we've had a lot more performance, I think, in the auto sector. And even now in this current rally, they've been pretty strong. So it's a good sign. I think, at least what I remember from 2005, autos did extremely well between 2001 to 2005. And then after that, 2005 to 2008, in the final stage of that bull run, the auto sector went flat, and you still had growth in infra and capital goods sectors. So we haven't reached there yet, because we are still seeing performance in autos. And that's sort of a sign that we are not yet reached mid-cycle, as you call it.
Okay. Now, two types of stocks at the opposite ends of the spectrum. One, new age tech, and the PSUs. One is like hugely, some people would call it overvalued, but there are a lot of takers who have come up in the last 6 months also. And the other lot, of course, we know is perpetually undervalued. You just buy them cheap and, sell them slightly at a better price. So how do these two lots look?
So I have a liking for PSUs, and I've had that for now 1.5 year, and I have stayed away from the new age. Though I like some of the businesses, would like them at some point. The theory for us is that uh, when these businesses get listed, I usually like to wait it out till a market's been through a proper bear market, which then sort of shakes out all the excesses that may have occurred at the time they got listed and so on, and you get a better entry point, and then from there you are actually able to judge whether the businesses are growing on a long term basis and give you that participation. I think that's the risk with the new age businesses. They fall in a bit. They're picking up with this current momentum in the market, but I'm again not very comfortable, and so that's a segment I'm sort of just avoiding.
But Rohit,
But yes,
what do you mean by a shakeout? You mean a business shakeout, or because if you were to assume a bull market, then where is the question of stocks relenting?
so okay, this is a tricky subject, and I'll tell you how I come about it, because my approach to markets, and one of the reasons I've chosen not to be an advisor ever, is that I can think like an independent investor, right? So when I come up with my logic, it is like, how would I approach this? Would I apply for an IPO of these companies when they got listed? And looking at the valuations at which they get listed, the answer is always no. And there's a reason and thinking behind it, because the entire investment game around these stocks has become an investment banking story. And this is something that we need to accept as individual investors, having watched the market long enough.
Yeah.
That there used to be a time when if you were a new company, you could simply come to the market and say, "Hey, I have this new business idea. I want to get listed." And it was 1994. After that, the rules to get listed got tougher. And eventually that meant that if I have a new business, I end up going to a venture capitalist. If he likes it, he funds it, he grows it big. A lot of people participate along the way. And by the time it comes to market, it's a multi-billion-dollar company. So a lot of the upside has actually been taken away already by the private investors when it is being sold to individual investors. That sort of makes me uncomfortable with participating in IPOs in general. And so once they get listed, what happens is that the excess that is there in the form of people who've participated in this journey and want to get out, maybe take those gains off the table, that unwinding needs to completely play out. And it sometimes takes it takes an equity bear market for something like that to actually happen. So unless we've seen a serious equity bear market, we don't want to judge that the shakeout in terms of the hands trying to move out of these stocks to new investors who will participate in the next cycle. And second, the valuation getting low enough, because it takes a bear market to get valuations to a level where it starts making economic sense to invest. That whole play out only occurs if you get a serious bear market. So that's the reason to wait, or at least give it 4 to 5 years after being listed, and then consider it that, okay, now should we look at this company or this stock? So that's the approach I take with all of these companies, that let them be listed, let them be around, and then we take a call of what is really happening.
Sure. Fair enough.
Now,
And the PSUs.
yeah. The PSUs, I think, are a great cyclical space, because they are some of the largest companies in a lot of the cyclical industries, whether it's metals, whether it's power, whether it's electronic manufacturing, so oil and gas. I mean, it just goes on. So these are all cyclical areas. Now we can make a comparison to previous booms like this, which is the best one is again 2001 to 2008. PSU stocks usually move from what is value to growth during that phase. Now, people who've seen it for last 10 years only remain in the value zone and do nothing, tend to think that these are just stocks to buy cheap and then sell a little dearer, but you never get a growth cycle. But imagine that if the economy keeps expanding at 5%, 6%, 8% every year, for companies of this scale, eventually, and you have simultaneous inflation, right? So you have a growth plus inflation combination, which means pricing also moving up for a lot of the products that they're selling. And at the same time, you have growth happening in the background. Then eventually these companies go through a period of growth and re-rating. I think that is what is happening over the last 2 years. We've seen these companies slowly moving out of the value zone. They're still not completely out of the value zone, which is why we're still not seeing the growth cycle fully play out. But when cyclicals are doing well, I think these stocks have a lot of upside potential to really give you returns, and they're large caps where funds can easily allocate large amounts of money. So I think it's going to happen. I think this is not the end of the PSU bull run. We are barely maybe 30% into it, I would think, at this stage.
Sure. Thank you so much, Rohit. It was an absolute delight talking to you. Thank you so much.
Thank you. Thank you for having me.